Before anything else, listen to this, traders.
This could be the breakthrough you're looking for in your trading. So watch this as many times as you need to. So as you can see here, we're bearish, and each of these down close candles represents the daily time frame. What this means is this: if we want to sell in a direction of the daily time frame, we need to be selling above the opening price of these down close candles. But let's really dissect it. Say price opens here. Naturally, if we want to go lower, price will go higher first, and this is where we want to sell, because we're selling above the opening price. Now, once we sell, price will start moving lower, leaving behind a wick, and finally, it'll retrace and close bearish. Let's go over an example to see this in action on the lower time frame. Here, we're overall bearish, so we want to look for a setup above the daily open. And as mentioned before, to go lower, we'll let price go higher first and leave behind a wick. Then we'll look for a setup. Since we took buy-side liquidity while traveling above the opening price, then broke the structure lower with displacement, we'll just enter a sell on a retrace into the fair value gap now. All that's left is to simply let price move lower for the day and finally close out.
Basically, there is what you are supposed to learn before you start to use this strategy. Before I explain in a manner that every trader will understand, let's first understand some terminologies for the sake of beginners in the industry. He mentioned fair value gap, sell-side liquidity and buy-side liquidity, break of structure, retracement and displacement. So let's start by understanding a fair value gap. So, what is a fair value gap? In Forex trading, a fair value gap, FVG, is a concept used to identify areas in the market where price action shows inefficiencies or imbalances. These gaps are formed when there is a significant difference between the buying and selling pressure, causing the price to move rapidly in one direction, leaving behind a gap or a range where little to no trading occurred. How do you identify a fair value gap? Fair value gaps can be spotted on charts as large candles not fully overlapped by the wicks of neighboring ones, differing from small gaps that don't show significant buying/selling imbalances. That's all about a fair value gap. Let's understand about sell-side liquidity and buy-side liquidity. Liquidity is the first, and arguably the most important concept within the ICT trading methodology. There are two types of liquidity: buy-side and sell-side. Buy-side liquidity represents a level on the chart where short sellers will have their stops positioned. Sell-side liquidity is just the opposite. It represents a level on the chart where long-biased traders will place their stops. In both cases, these levels are often found at or near extremes, as the tops and bottoms of ranges are often viewed as areas where traders are proven wrong and, therefore, will want to get out of their trades. Smart money players understand the nature of this concept and commonly will accumulate or distribute positions near levels where many stops reside. It is, in part, the sheer amount of stops at key levels that allow a larger player to fully realize their position. Once the level at which many stops are placed has been traded through, it's often that the price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. That's all about buy-side and sell-side liquidity. Let's now understand the break of structure. A break of structure, BOS, is an integral concept signifying trend continuation rather than its weakening or reversal. In essence, a break of structure occurs when, within the context of an uptrend, the market creates a new high beyond the previous peak without breaking the previous low. In other words, the weak resistance has been broken, forming a new high and signaling the bull trend is continuing. Similarly, in a downtrend, a break of structure is identified when a new low is established lower without moving beyond the prior high. This pattern underscores a continuation of the existing direction. That's all about break of structure. Let's now understand retracement now. Understanding retracement patterns is essential for traders looking to capitalize on market movements and identify strategic entry points. Retracement patterns occur when the price temporarily moves in the opposite direction of the prevailing trend before resuming its original trajectory. That's all about retracement. Let's as well understand displacement. Displacement, in short, is a very powerful move in price action resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have large real bodies and very short wicks, suggesting very little disagreement between buyers and sellers. Often, a displacement will occur just after a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. Now, let me summarize the video you have recently watched. 1. Know the opening and closing of a candlestick pattern. 2. The secret is knowing the direction of daily time frame. Without this, you will not be able to make money using this strategy. 3. Keep in mind you are going to sell above the opening price of the daily candlestick pattern. What do I mean? Remember that, before the market sells, it will buy first to cheat you. This is what we call inducement. 4. Go to lower time frames, look for a setup above the daily candlestick open. Here, let the price rise, expect to see a wick which shows rejection from higher prices, taking out the buy-side liquidity and displacement, breaking the structure level which is also known as break of structure. 5. Take your sell trades on the retracement into the fair value gap if you see any, or as well, you can look for break of structure to confirm a continuation to the downside. So traders, this is basically what you need to know, and it brings us to the end of this video. Let me hope it's helpful. Don't forget to subscribe, like and share. I will see you in my next video. Listen traders, before you make any big mistake, like paying for that expensive course, try reading this book first. This is basically what you are going to be taught by your mentor. In fact, not even everything. If you are a beginner and you have learnt only basics, don't dare funding your Forex account because you will not like the results. This book will introduce you to another side of Forex trading because you cannot like forever buy at support and sell at resistance. This book comprises of everything you need to know about smart money concepts and price action, and everything is explained simply. Grab your copy at $10 only and it will save you from a lot rather than paying for Now,
those so-called
if you want to kick off your Forex journey, WhatsApp this number to order your copy. First come, first serve.